we have quorum. I don't know, Susan said she'd be here, but if Miss Bledsoe doesn't mind to chair,
No.
we can go ahead and get started.
Sure. Okay. Let me look at this while we start. Special retires election results.
Yep,
that
I'll take
you?
care of that. So in December, we had a special election for the retirees, and Gay, Rosemary, and Charlene were all re-elected,
Congratulations.
and then it was counted and verified by Mr. O'Mara and Martha Allen.
Great. Do we need a motion to approve their election or thing, or something?
Just
Good.
for information.
Okay. Great. Okay. Did we have any comments or amendments to the minutes from October 31st?
Motion to approve the minutes.
Second.
Great. All in favor?
Aye.
Aye. Great. Thank you. Do you want to go over second quarter expenses? You? Or,
Do you wanna, that's,
It's informational purposes.
fantastic. And then ratification of the payroll. Can I get a motion to approve?
Make a motion to approve.
Second?
Thank you. All in favor?
Aye.
Thank you. And then the funeral benefits for this year, for this quarter. I don't see the funeral
Very
benefits.
exciting.
Oh, I'm so sorry. For Mr. Payne. And okay. And no benefits are due.
And was a widow, so there's no benefits paid.
Great. Okay, you want to go over investment
Sure.
protocol?
I thought we sent more.
During the fourth quarter, it was a very good quarter with performance for the return-seeking portfolio. That is the excess that covers all the liabilities, generating a total return of 3.89%. This is a change in market value of $691,902, and that's just for the fourth quarter from October 1st to December 31st, 2017. As you will see later in the report, the return for the return-seeking portfolio in 2017 was 15.82%, and that was 87 basis points ahead of the benchmark. The liability defeasing portfolio, as you may recall, over the last several years, one of the things that we wanted to do was immunize the risk that's for the amounts paid to the beneficiaries. So we have a portion of the overall portfolio dedicated to meet all those expected liability streams. That return was 0.37% during the fourth quarter because it's an all fixed income portfolio. During the fourth quarter, there weren't any tactical changes. We kept the asset allocation similar to what we saw during the third quarter. That's driven basically because it's like the underlying fundamentals of the market remain similar to what we were experiencing 3 months ago. So some of the highlights of the economy. We sent this out last week, but fourth quarter GDP was released on Friday. During the fourth quarter, GDP growth was 2.6%. That brings the 2017 average to 2.3%, and that compares to 1.6% for 2016. So growth in the U.S. economy remains robust. We saw 2 back-to-back quarters with growth above 3%. We were hoping for a third, but it is definitely a faster pace than what we've seen in many of the recent years. On page 4 is a summary of the labor market. The economy continues to add an extraordinary number of new jobs. During 2017, 2.06 million jobs were added. This was a very quick pace, but it was the lowest number of job growths in any one year for the last 7 years. In addition, the unemployment rate continued to tick lower, and we've seen we now see the unemployment rate at 4.1%. So that was a pretty remarkable improvement for 2017 when we started the year at 4.7%. What we are now experiencing is a point where the economists would say that we're at full unemployment. That at 4%, it's like, yes, there's people that don't have jobs, but those people don't have jobs because they are electing to not have jobs because they're going from one job, maybe moving from one region to the country to another region. So we are expecting, in a lot of parts of the country, there's a extraordinary pressure for skilled workers. That employers can't fill jobs because they can't find workers with the adequate skill sets to meet those requirements. So at some point in time, wages should increase in terms of, as employers try to attract those individuals, they're going to have to pay a little bit more. But wage growth hasn't seen a sharp rise as of yet. It was only 2.5% in 2017. So all these things bode well for the economy. The economy is on a very strong foundation, and we are seeing the Federal Reserve be a little bit more aggressive with its monetary policy and tightening. In 2017, we saw the Federal Reserve raise rates, and these are the rates on the short end of the yield curve, by 3 times at the March, June, and December meeting. So the rates are now in the 1.25% to 1.5% range. And we are expecting, and what the Federal Reserve is telegraphing, is that there might be another 3 increases in 2018. One of the biggest changes that we're going to experience as of this week is a new Federal Reserve chairperson. Janet Yellen's term officially ends as of January 31st, and Jerome Powell is going to become the new Federal Reserve chairperson as of February 1st. He's been a member of the Federal Reserve Board since 2012, so he has experience with the current board as well as the understanding of the policies that they've implemented since the financial crisis. And many in the markets were expecting him to be the front runner for the new chairperson. And he is essentially what some people are saying, the Republican version of Janet Yellen. He's going to continue, is expected to continue the policies that Janet Yellen set forth. So we're expecting a continual rise in monetary policy with the short-term Fed funds rate going up a couple times, as well as some tapering of the Federal Reserve's balance sheet in 2018. In regard to the return-seeking portfolio, the stock market did extraordinary. The S&P 500 in 2017 was up 22.4%. The Dow Jones was up 28.7%, and the NASDAQ was 30.6%. A couple pieces of trivia: every single month in 2017, the stock markets rose. It's the first time that we ever saw every single month in a calendar year the stock market rose. So that is just a remarkable accomplishment for the stock market. And that is partly due to anticipation of new tax reform policy. One thing on page 9 is that at the end of December, the Tax Cuts and Jobs Act was passed, and the biggest takeaway was that the corporate marginal tax rate actually is being decreased from 35% to 21%, and that pass-through business deductions were also reduced. In addition, they changed the rules on repatriated cash, which will allow these companies that have been hoarding cash overseas to actually bring back those monies into the United States. And about 30 to 40% of corporations indicate that they're going to actually use that repatriated cash in order to buy stocks, rebuy their stock. So this all bodes well for the stock market and continued profitability. So one of the questions is, and that's where the chart on page 8 addresses, going back a slide, is where are we in terms of valuations? The blue line shows the historical PE ratio since 1992. And when it was greater than 1 deviation, when you look at back 97, 98, 99, That was right before the tech boom crashed. So you had a couple years where it was greater than one standard deviation, and then it fell sharply. If you look today in September of 2017, we're approaching that one standard deviation, but we're still within the historical band. So we think that there is still more room for the stock market to continue to increase, and the tax reform package is actually going to basically allow almost an accelerant to corporate profits. So in terms of, from a P perspective, we're actually probably going to see that maybe tick down a little bit because businesses are going to be able to retain a greater amount of their earnings, and then that's going to actually justify a higher valuation. So far in 2017, the stock market's up 7%. So we saw it decrease yesterday and decrease today, but some were saying that this is the first back-to-back decreases in over a year. So the stock market has been on a remarkable tear. Overall, our outlook for 2018 is that the economy is going to continue to show above-trend growth in the U.S. and also internationally. So there isn't pockets of weaknesses. In prior years, we said that the U.S. economy was doing okay in the 2 to 3% range, but there were emerging market economies or some major bellwethers that were basically dragging down the rest of the world. Now we're actually seeing the entire world be on positive economic growth. For interest rates, we think we're going to probably still see a continued rise. The yield on the 2-year Treasury note is at the highest level since 2008. It's now over 2%. We haven't really seen that translate into better rates for individuals at local banks, but this is definitely a trend where you're going to see higher short-term rates that affect all parts of the economy. The longer end of the yield curve, which influences mortgages most notably, hasn't really seen a corresponding increase. So even though the short end of the yield curve has increased by 75 basis points, the long end of the yield curve hasn't increased by the same amount. So we're still seeing that housing market is going to remain strong with mortgage rates in the low 4% range. The central banks, there's going to be the new Federal Reserve Chairperson, Jerome Powell. He's expected to maintain the current monetary policy with 3 rate hikes in 2018, as well as the European Central Bank and the Bank of Japan becoming slightly less accommodative, partly because of their economies doing much better. Equities, we closely monitor the equity markets, but we still think, and we still have an overweight for the return-seeking portfolio in the equity sector because we think 2018 is going to be another good year for the stock market. And in the fixed income portion of the return-seeking portfolio, credit-sensitive securities that have allocations to corporate notes and also high-yield bonds continue to do very well in terms of, because the underlying fundamentals of corporations are strong, spreads continue to contract on fixed income securities. So going into the return-seeking portfolio, now our numbers are on the left-hand side, page 1.1. This shows the various indices. You can see up at the top, the S&P 500 was up 21.83%. International equities, which are the second set of blue rows, were up anywhere between 23% to 37% in 2017. Alternative securities such as real estate investment trusts and commodities, they were actually laggards. And as you see within our portfolios, we actually reduced their allocations or completely eliminated those allocations earlier in the year. So those would have been headwinds if we had exposure into those stocks. And then the fixed income market, high yield, and more credit-sensitive securities posted the best overall returns. So other things to take a look at, I think you would be page 1.8. It's the chart with the red bars on the top of the page. So in terms of the blue represents our current outlook, the gray bars represent our outlook last year at this time. So we continue to have a very favorable view of U.S. equities, especially in the large cap area. Those are the large conglomerate names like General Electric, Google, Apple, Walmart. Small cap had a very good year in 2017. We're still quite positive in that market. Non-U.S. equities, you can see that we have a pretty stark change compared to 12 months ago in terms of the underlying fundamentals of the economies outside the United States have improved quite significantly. So our outlook has greatly improved, and in 2017 you saw several tactical changes where we increased exposure to emerging market as well as international equities because of that change in outlook. Fixed income securities, just from a long duration interest rate sensitive securities, were pretty not positive, less constructive on that particular sector. We think that the Federal Reserve raising rates is going to cause some headwinds and cause returns to be depressed in that sector. But credit sensitive securities such as corporates and high yield bonds will post relatively good returns, but probably not as high as domestic equities. Real estate and alternatives, we're still relatively pessimistic on those sectors. On page 2.1, on the very top row, this is the total fund for the return-seeking portfolio. For the one-year return, that was 15.82%, compared to a benchmark return of 14.95%. The two-year annualized return was 11.05% versus 11%. We hope that you're very pleased with those returns because those translate into significant dollars for the City Employees Pension Fund, and you can see what those actually translate into in terms of dollars on 2.3. The return on investment, which is the middle row, third column over, the return-seeking portfolio increased in market value by $2,579,000. Pretty good. We would think that's a very good return for a market that came into the year that there's a lot of uncertainty with. So very, very strong returns. And then in terms of the positioning on page 2.4%, if you look at the total allocation across the domestic equity and the international equity, we have a slightly overweight. We're very constructive on equities both here in the United States as well as internationally. So the target benchmark has an allocation of 60%. We have a 65% allocation to those two sectors because of our positive view, which then means that we're slightly underweight fixed income securities. So we have a target of 40%, but we have a 34% allocation. And we think that's going to help overall performance and generate good returns for 2018. Any questions about the return-seeking portfolio?
I'm assuming you're hoping that the interest rates or the increase in, I'm sorry, I apparently have a cold all of a sudden and I can't think clearly. But then people are talking about there's going to be some kind of market adjustment, some kind of inflation coming this year. Do you not think so?
In terms of...
Doesn't sound like it.
I mean,
Yeah.
I didn't hear that.
Right. So in terms of inflation, it's definitely a barometer that is widely looked at. It would be a gauge for the Federal Reserve to raise rates more aggressively.
That's what I was curious.
But in terms of inflation, continues to be very much held in check, lower than 2%. In terms of some Federal Reserve Reserve members actually are looking for ways to boost up inflation, because inflation has been such at low levels, is that we're not even hitting the 2% levels. And if you don't have some level of inflation in the market, it causes people to be a little bit more agnostic to their buying decisions. In terms of, if you know that you could buy a car at the same price next year versus this year, you would why buy? You just kind of hold off on purchases. So in terms of, you definitely want an economy that has some level of inflation, otherwise you start really manipulating consumer behavior. So in terms of we've seen a small uptick in oil prices, but a lot of things continue to be held in check. So we're actually hoping that there might be a little bit more inflation in the economy, as opposed to any fear that it's going to come like rampant, and that the Federal Reserve is going to have to take some extraordinary action. So.
And what about the equity correction? You don't see that in 18?
If we might have a small correction, it's like, this is one of those things where it's like, the director of research says it's like, you would expect some type of correction.
For 3 years now.
Yeah, right, exactly. But if the market is up 10% and you have a 10% correction, you're actually at 0 for that year. And we're already up 7% year to date. So if we have a 10% correction, we're not really down from much from where we started from. So in terms of you might see a blip and you might see a few days where there's negative returns, but the overall path and the underlying fundamentals are quite strong. So I think the biggest concern is reducing the overweight, and we would reduce the overweight if we start seeing the valuations become much higher and outside that band. But now that we're adding additional earnings with the Tax Reform Act, that's going to actually do quite well in 2018 and probably into 2019.
So you think the tax reform offsets the high PE?
I think it's going to actually lower the PE.
Yeah.
So in terms of, we're going to have more room to actually expand into a higher PE ratio. So.
Okay, let's hope so.
Yeah. So in terms of,
All right, you're on.
it's a
You're
remarkable
on camera. You said that.
it's just a remarkable market in terms of looking at volatility. One of the things that we're in terms of concerns is that if our people, there's this belief of FOMO, F-O-M-O, the fear of missing out. In terms of that, at some point in time where you're seeing 30% returns, that instead of doing some fundamental analysis of your own situation, that you just want to chase something. And that this money that chasing equity valuations will just continue to boost up the returns. We first saw it with Bitcoin, in terms of Bitcoin was just now introduced onto the major exchanges, and it made Bitcoin's valuation go from $12,000 per whatever currency unit to $19,000 in a matter of days, that people were just throwing money at. And there is some speculation that that might be happening in the S&P, but we're still probably a year or two out. So, liability defeasing portfolio, as we originally set up over almost 3 years ago now, is that we set aside a amount of money that would cover all the expected liabilities based upon your actuary assumptions. The yield to maturity at market of this particular portfolio is 2.45%. The yield to maturity at cost is 2.25%. It has a duration of about 6.5 years, and it's very well positioned in order to meet all of your quarterly draws that has historically been made. During the fourth quarter, $211,000 was withdrawn from the liability defeasing portfolio. It's a very high quality portfolio, taking advantage of the corporate spreads. We've seen spreads contract. One of the new purchases that we made in the portfolio this quarter was Johnson & Johnson. It's a AAA rated name. It was a new issue. We didn't have exposure to that particular name in the portfolio, and we swapped out one of the treasury strips that we own into that particular security in order to boost up yields. So this is doing exactly as we are expecting. Not much to report here, but in terms of, it's a very safe and sound portfolio that we expect to fully cover all of your expected liabilities from the state employee pension fund. Any other questions?
I have a question. It's a research question, actually.
Okay.
Can you double back with Chad Hancock and make sure we're allowed to have BBB in the portfolio?
Yeah. In terms of investment policy, allows for investment grade.
Okay.
obligations, and triple, yeah, and
I
triple
just
B
wanna make
are,
sure
yeah,
that's
and triple
okay.
B, and triple B are still investment grade, so.
Okay.
yeah.
Okay, any other questions?
No, I just want to play this back a year from now, see how well you did.
Not saying that you're gonna get 30% return, but in terms of,
No, no,
it should be, yes.
I'm good.
Yeah,
We'll take positive improvement.
yes.
Thank you very much for coming.
Oh, thank you.
Does anybody else have any other thoughts, questions, issues? No? Can I get a motion to adjourn?
So moved. Second?
All in favor?
Aye.
Great, thank you all so much.
Thank you.